Exchange traded funds, also known as ETFs, which I'll be referring to throughout the course of this video. They are an awesome way for investors of all shapes and sizes to get into the market on a very simple and cost-effective method. So what is an ETF and what does it do? An ETF will typically follow a particular index, the most common one being the S&P 500 index, but they can follow any index. They can follow the Barclays Bond Index, they can follow the Russell 2000, they can follow the Dow Jones, they can follow any index, and sometimes even companies will actually make up their own indexes out of thin air and then build an ETF around that index. ETFs are a great way for investors to get immediate diversification because when they buy an ETF, it's typically very cost effective. Usually you can get ETFs for under a few $100s for one share, but then you will have access or exposure to maybe 500 stocks if you're buying into the S&P 500 ETF fund. They're also very low cost. You're typically paying maybe 10 basis points to maybe 25, 30 basis points at most. So they're much more cost effective than owning a mutual fund. One of the drawbacks, however, is that they're not professionally managed. So they are a passive investment, meaning that if you want to be very precise and strategic, you're not going to get that level of advantage, unlike a mutual fund. A mutual fund is going to be much more precise and allow for typically more planning in advance with regard to the investment decision-making process. So ETFs, while they're a great way to get exposure for a very cost-effective method, they don't always have the additional level of complexities that some investors are looking for when buying a mutual fund. In summary though, ETFs are a great way to get started because they're, again, super cost-effective, relatively tax efficient, and they're very easy to understand.